and he's a market master of the day. Mahesh, great to have you with us here on the program. Thanks very much. So much has happened, right? Last 4-5 days. How would you look at all of it, and what are the prospects for the markets, Mahesh, as you see it? I mean, by the way, the data for inflows into mutual funds hit a new high, right? So absolutely no shakeout there, which means that funds and you guys have money to invest. Are you doing so at this point is the question. Go on.
Yeah, good morning, Prashant. So I think there has been, in the last week, couple of weeks, we've seen that, as I said, expectation of interest rates going up and remaining higher for long was something which really affected the market, global markets and our markets also. And the recent incidents of SVB also had an impact. But I think the Fed has done a good job in terms of giving a backstop, right, for the depositors and providing liquidity against the assets. So I think that should give confidence back into the banking system. And as a result, we have also seen that with these kind of issues coming up, I think the Fed is now likely to probably go a bit slow in terms of rate hikes. And that is give some relief to the market over here. I would say that clearly, I think in India also we've seen the rates have gone up quite sharply, and that will have some impact in terms of growth. We have seen a few sectors like consumer durables, even mortgages slowly starting to get impacted. And I think that will have to get factored in terms of the numbers as we build our expectations for FY24. Though I would say that overall, if I look at it, in India at least, there are a lot of sectors, right, whether it is the banking sector, the auto sector, or even for that matter, metals, for example, all these, even IT sector for that matter, should report fairly reasonably good growth next year. So even if there is a slight downgrade, we don't see any material impact in terms of earnings getting hit in the next fiscal year. We are still looking at a double-digit growth for Nifty earnings next year. I think in that scenario, I think the markets, while currently, there are no any positive good news, markets should probably do some kind of a time correction. But frankly, one should not see too much of a downside from here. And now with the markets having remained here for last more than 1 year, almost 15 months, the valuations are also now reasonable. So if I look at the valuations from a long-term perspective, the market is no longer expensive. It is near the long-term average. So given that the earnings growth what will drive the market trajectory from here out is what I would see. And as I mentioned, the liquidity also scenario, like inflows remain fairly decent. So that should provide the support to the market. While FIs have seen some amount of selling in the first 2 months. But there again, I think the differential of India was at a premium to the emerging market significant. That differential also has come down because India has underperformed. So one should not expect too much of selling from FIs also going forward. So I think that should provide a kind of a downside support to the market. And I think slowly from here, I think market should consolidate. And we still remain fairly optimistic, positive over the next, over a medium term.
Okay, by the way, I think the market is perhaps listening to you because it's a really good start. The Nifty is now up almost 100 points and is taking heart from all of the the soothing comments from the US regulator on the SVB issue. So Nifty now at the high point of trade, the Bank Nifty as well in the green. Mahesh, the stock of the moment is Tech Mahindra on the appointment of a new MD and CEO. Now, I know you don't want to comment on individual stocks, but there was, of course, a lot of uncertainty with respect to the succession plan, no clarity. But now there's, clarity in place. What do you do with names like Tech Mahindra that have perhaps underperformed up until now? And in general, what's your view on the IT space? Are you buying now?
Yeah, so I think many companies, we've seen that any leadership change can lead to a significant re-rating because depending on the leader, I think the market can then draw down in terms of what's the long-term trajectory of growth for that company. So I think that's a significant moment for any company, especially where we've seen the company underperform for a long period of time because of compared to the broader industry. And I think that is something which market always takes it positively. And I think we've seen that in many companies in the past where there have been significant leadership change. Over a period of time, depending on the delivery, the markets can have re-rated those stocks. So that's how we look at any leadership change. Overall, on the IT sector, we have been fairly positive. I would say we were negative on the IT sector around 6 months back. and slowly our negative has kind of come down, and we've kind of neutralish to mildly positive on the IT sector. And the reason for that is that we are not seeing now, based on the commentary from the large IT names, we are still seeing around 8 to 10% kind of revenue growth next fiscal year. Earlier market was we were expecting around 5% kind of a revenue growth, and more importantly, the margin trajectory overall for the IT company should be fairly good going forward, because the pressure on the employee cost is now easing off. Rupee has also depreciated a bit, so that should aid. So as I said earlier, we're looking at a double-digit bottom line growth. While the top line growth will be high single-digit for the IT sector, the bottom line would still be in the double digits, around 12 to 13% growth, which is a fairly good growth in this context if you look at the current macro situation. And it's a sector which is over a longer term also, we believe the whole digital move toward digitalization is a long-term theme. And this is a good time to really to accumulate some good IT stocks which are really focusing on the whole transition into digital side.
Got it. By the way, just want to point out that Equitas Small Finance Bank is down another 5%. Remember, it was on Friday that with the the reverse merger being complete, shareholders actually were allotted shares, and a lot of those shares were getting sold in the market, perhaps because the stock had run up a lot. But that is still continuing today. So just wanted to point that trend out. Mahesh, hi, good morning. Surabhi here. Let me ask you a wider question on financials. Today, we're seeing, of course, decent pickup in a lot of the top-tier banking names, both private and public sector. The mid-cap and the small-cap banks are kind of still on the periphery. What's your approach to financials? What are you comfortable buying into, and what would you stay away from?
The financials, after the initial run, what we saw last year, has seen some kind of underperformance, though I think there's nothing to worry about there in terms of the results. I think that the results next year should fairly be on track. We are not seeing any kind of material downgrades to the financials. And while I think on the banks, I think they have benefited because of the increase in interest rates. Okay, but I think we will see some pressure on NIMs going forward from the first quarter of next fiscal year. But I think that is factored into the numbers, I would say. There is a chase for deposits in a big way, and banks are really running around to get deposits, and we've seen almost 200 basis point or more increase in the deposit cost. So I think that will start to now filter in going forward. But having said that, I think the sharp increase in NIMs, what we saw in the last 2 quarters, I think market is already factoring that they will come down. Overall, I think the numbers should still be good. Credit growth also, we're expecting that to moderate down. Okay, compared to around 15% growth, what we've seen. Expectation is it will come down to around 10 to 11% because overall nominal GDP growth is expected to come down next year because inflation, especially WPR, is likely to come down sharply. But all in all, I would say that banks still offer reasonably good risk reward in terms of the growth as well as the valuations. Valuations are fairly reasonable. And I think banks with a good liability franchise, I think, would be something which I think would do well in this context where, the liabilities costs are likely to increase going forward. So larger banks with good liability franchise and a good mix of retail and corporate. I think we've seen some pickup in corporate loan book also, which was kind of flattish or negative for the last few years. There has been some pickup over there. And overall credit cost should still be fairly benign. We don't see any substantial increase, at least in the next fiscal year. So overall, still positive on the banks. I would say it's underperformed, but it's a good opportunity really to look at some of the larger banks.
Okay. All right. We will leave it at that, Mahesh. Thanks a lot for joining in. Appreciate your thoughts. By the way, the market is still holding up with good gains, 100 points higher. The mid-cap end of trade is